again, persistently higher energy prices will eventually work its way into the prices that we pay for, let's say, goods.
This war in Iran, if anything, probably serves to accelerate and reinforce those trends.
It's like, what's the incentive for some of these management companies to stick their neck out and actually make a bold call in here? If anything, hide from that and basically
use it as an excuse.
Exactly,
not to
100%. Yeah. So don't give much of any sort of inklings in terms of the forward guidance.
And so our portfolios are still set up in a way that I think allows us to participate, will allow us to participate in strength, but yet give us dry powder if we see some downside for whatever reason.
As we always say, the reaction to the news is more important than the news itself. I'm Jack.
I'm Brian.
This is Tactical Take.
Hey Jack, how you doing?
Back at it.
Back at it, another month. Last month we started the podcast with the war in Iran, and I think this month we're going to have to do the same thing. Yeah. It's top of mind for everyone. It's still the dominant market driver. That said, this time we have a ceasefire in place and markets have started to rebound. So I thought let's start with the ceasefire and get a sense for how much of a game changer you think this is. Is it changing your outlook on things?
Yeah, I think the big takeaway from our perspective is, and we've talked about this in the past where we discuss the risks in terms of tails, right? The upside right tail, the left side downside, the downside risks for the left tail. I think the ceasefire has at least chopped off some of that downside left tail, so to speak. Okay. So again, just reframing the potential worst case scenario that's probably been short-circuited to an extent. Is it completely gone? No, but you can certainly see how the market's reacted accordingly. So again, the market's been pretty quick to price out that left tail risk pretty aggressively in here. So I think that's probably the right way to think about it.
Okay. So basically cutting the risk to the downside, but we're definitely not getting an all clear signal here. How about on oil prices? They're back above $100 as we're recording this morning. How far do you think they need to fall before oil prices stop being a threat to growth?
Yeah, that's a good question. I think that maybe it's more so the trajectory that the back end of the curve, so to speak, is pricing in. So think about maybe just the December contract for the rest of this year. Is it down significantly? And yeah, I guess we could say it's trading below $80 a barrel looking at Brent. And so based on where we are with spot relative to where that is towards the end of the year, it's a market decline. And I think that's what the market's really hopeful for. And that's the bigger issue right now. It's always been duration and how high. And this is giving us, more and more indication that the market still sees this as a short-term disruption, and we'll get through this. Oil prices probably end up a little bit higher. There's still probably going to be some geopolitical risk premium baked in, but is it enough to really cause a recession, so to speak? At the margin, maybe you get a little bit of slower growth, but I don't think it's detrimental to the overall global economy.
So as long as the deferred, like December, the contracts for early next year stay well below $100 a barrel, you're generally comfortable that we're not going to have some kind of like oil spike induced growth scare.
Exactly. Yeah.
How about on inflation though? So we've been pretty comfortable with the inflation outlook this year despite the levels being above target, and we were hanging a lot of that on housing or shelter related inflation. I'm wondering if your thinking has changed at all with respect to the inflation risk, given that now we have a new source and a fairly potent one coming from the commodity price channel.
Yeah, and I think the risk here is that higher commodity prices ultimately start to bleed into the real economy, right? Because we know the Fed pays attention to core inflation, and core inflation strips out food and energy prices. But, again, persistently higher energy prices will eventually work its way into the prices that we pay for, let's say, goods. And that's the risk. Right now, we're still not seeing that, but early in the game here. And again, this is all a function of how high and how long these oil prices remain elevated. I thought another interesting piece, though, one of the regional Fed banks, I think it may have been the San Francisco Fed, put out a report where they were looking at the impact from tariffs. Right. And we haven't talked about tariffs in a little while, but they were basically saying two things that I thought were interesting. One, that basically all of the excess inflation coming out of core PCE, so basically above that 2% target right now, has all been predominantly from tariffs.
Yeah, I saw that report. Okay.
And then I think the second one there, which I also thought was interesting, is they're also arguing that peak tariff inflation-related issues are now behind us. Mm-hmm. And so we start to see that rolling over. And what's interesting, again, keep in mind that inflation is a change, right, a rate of change. And so if you think about when those tariffs were put in place, April of last year, that's the base effect for which we're measuring that change in inflation.
We're lapping it.
Yeah, now all of a sudden that base effect starts to move higher, and now it makes it look less, impressive from a growth perspective.
So while we have a new risk of inflation from energy prices, goods prices in general, like by extension, maybe the tariff component of inflation will start to lessen, and we're still comfortable with the shelter component of inflation being a disinflationary force.
Right. And if, again, we pay attention to a lot of those market metrics where you look at 1 year inflation and then 1 year inflation, again, the 1 year inflation numbers have elevated but are starting to come back down again. That 1 year inflation 1 year from today, that 1 year forward rate, really hasn't moved much. So again, the market's telling us this is a short-term impact. Look through this because this will all sort of fade away eventually. And
the market's
so
very
far so good
with the medium-term inflation outlook.
Yep, exactly.
Was there anything in Friday's CPI report that caught your eye? We got the March CPI on Friday.
Yeah, there's a couple of one-offs in it that were kind of quirky, if you will. But again, the stuff that we sort of have been seeing pressures from, so things like airfares, which not surprisingly, if oil prices are going up, jet fuel prices going up, airlines have to pass that on, and that's where you're seeing some of the increases being picked up. So the idea of it bleeding through to the real economy, that's one of the areas we're certainly seeing it right now. That had jumped up, again, some issues on cars, autos, insurance prices there. Those are all ticking higher. But these are sort of these weird one-offs that we're seeing. And so I think from a broader base perspective, things are still, I think, comfortably in a range where we're still good with it, I guess.
Okay, so still fairly comfortable with the inflation outlook. Not a reason for us to hit the panic button on the bond market or anything like that. Okay, and then I guess finally on this topic, how about the central bankers?
Yeah.
Do you think their impression about inflation is changing? That matters even more than ours, probably. Yeah. That could be anyone. It could be obviously the Fed, but it could be the ECB or the Bank of England.
And it gets tricky because, again, the Fed is one of the only institutions that has that dual mandate, right? It's going to have full employment and price stability, whereas if you look at the BOJ or the ECB, they're really only targeting the price stability side of the equation. So if you look at what the market's been pricing, in the U.S., futures had moved to actually looking at potentially small hikes between now and the end of the year. That's now been priced out. So the market's now saying by the end of this year, the Fed stays on hold, which is probably the right thing. I think the Fed should be sitting on their hands waiting for this to play itself out. But if you look at someone like the ECB is actually, or the market's telling us that the ECB might potentially hike by 2 times by the end of the year. So again, they don't have the price they have the price stability mandate, but not the full employment mandate. And so you can kind of see how maybe some of those other banks might lean a little bit more hawkish, if you will, than what we're seeing from the Fed.
For them to be doing their job, it might just mean hiking rates. Because
exactly.
They can say, look, we hiked rates to try to control this inflation that's rising, and they don't have to worry about collateral damage in the economy.
Exactly. And maybe the last one to point to on the BOJ, the market has already been expecting them to hike rates, and basically those expectations really haven't changed. So at the margin, really no new information for the market to absorb there. So no real change in expectations. Still expected to hike.
And that's been the case for the
exactly.
BOJ has been in a hiking regime for quite a while
right.
now. Okay, let's switch gears to the investing from here and talk about our models where we made a recent trade at the beginning of April. So we made a small de-risking trade, sold out of our position in S&P 500 equal weight technology, put the proceeds into the U.S. ag. That was essentially a reflection of what you talked about, I think, at the outset, how the balance of risks is maybe not as bad as it was before this ceasefire, but it's still kind of two-way, where we can see downside scenario unfolding, particularly if oil prices remain elevated, but we could also see an environment where things continue to do well, the economy ignores this, if oil eventually comes down, earnings arrive as scheduled, and we get a nice continuation of the rally. And so our portfolios are still set up in a way that I think will allow us to participate in strength, but yet give us dry powder if we see some downside for whatever reason. So I guess just to put it to you, kind of like with the S&P 500 having rallied sharply off its recent lows, it's back in the ballpark of that 6,900 to 7,000 area it had been struggling with earlier this year. How are you thinking about the balance of risks and upside versus downside? Do you find the market attractive here, or more of a neutral type setup?
If I had told you that we're sitting, 2%, 3% below all-time highs, we have military activities going on in the Middle East where we're threatening to shut down the Straits of Hormuz.
Blockade, right?
The list goes on and on here. What would you think about the market there? You'd probably say, well, it should be primed for a correction, right? So, Again, just what we talked about, the skews of risks, I think probably a little bit more in favor of maybe not breaking through to make new all-time highs. So from that perspective, and that sort of feeds into what we were just talking about with regard to the potential upside downside risks here, lightening up a little bit is certainly one of the things that we were just thinking about with that perspective. But I think maybe what could change, we're going into earnings season now, and earnings are really the driver in here, and they've been holding up fairly well. The question is, are we going to hear from management something that might actually get a different conclusion to come from that? And we're going to find out over the next couple of weeks.
And do you think enough time has passed yet?
Well, that's the issue, right? Because again, as we sort of talked about in some of our meetings, it's like, what's the incentive for some of these management companies to stick their neck out and actually make a bold call in here? If anything, hide from that and basically
use it as an excuse.
Exactly,
not to
100%. Yeah. So don't give much of any sort of inklings in terms of the forward guidance. Say they don't have any clarity, they don't have any sort of better crystal ball than we do, and you don't really get much out of that. And so I think that could be the potential risk going forward. And personally, I think the market would probably spend more time focusing on guidance as opposed to the actual beats and hashing through the numbers there, because it's already happened. And so maybe we don't get sort of the clarity and the guidance the market's hopeful for, just because it's CEOs, managers don't have it.
And that could be another overhang that prevents us from breaking through that 7,000 level.
Right.
If we just don't have any kind of guidance we can rely on, and the historical looking data is not as valuable given the things have changed.
Yep.
Are there any areas of the market that held up very well through the correction that may have signaled some underlying strength that have caught your eye?
Yeah, and it's sort of the things that we had expected, right? It's the tech trade. We're seeing quite a bifurcated market within tech, but the semiconductors continue to still hold up quite well. And we keep hearing more and more about the shortage of compute power. So the processors and the chips there continue to actually have a pretty good supporting backdrop. And if anything, you can argue there's maybe some backlash from what's going on with the Middle East. You keep hearing about helium and how they're used to cool the wafers. Well, there's a helium shortage now, so is this going to slow down the chip production? So now we're going to get a chip shortage again. Yeah. So you can kind of see how the pricing there is probably still going to be supportive going forward. But from a broader perspective, we did see tech do okay. And is that a question of the tech having significantly derated? Right, we've seen PEs come
large
off,
cap anyway.
Yeah, 20 to 30%. So you've got a better cushion from a valuation perspective, and these guys still have decent growth numbers, pretty good margins. If you think about it from those defensive characteristics, maybe not surprising that they've held up pretty well in here.
All right, so tech is one area
that's held up pretty well,
resilient. Yep. Like if anything,
and I think it's basically go back to those same trends that were in place, and I would say maybe those sort of ideas that we were thinking about even before we started to have hostilities with Iran. Those maybe are just becoming amplified now, and things like defense spending, and not just here in the United States, but globally. Things like trying to onshore, reshore supply chain, trying to shore up supply chain. So that means bringing some of the industrialization back to the U.S. These sort of themes, I think, are still in play, and I guess you can go back to it. Instead of being maybe a bipolar world, it's now a multipolar world, and that just means you're really taking care of your own self-national interests, and those are being drawn along regional lines. And so that, I think, is one of the things we talked about in the past that probably still persists.
Yeah, those are secular trends we've been following for several quarters now.
Right.
And our colleague Luke the other day made an interesting point, I think, in one of our meetings, saying, this war in Iran, if anything, probably serves to accelerate and reinforce those trends. It sounds like you'd be in agreement with that.
100%, yeah.
And so if that's the case, we talked about, obviously, defense spending. That's a clear one. But also resource nationalization and nearshoring. I think those were the three big ones we've been tracking.
Yep.
Can you name any industries that might stand to benefit, or countries in which investors could look to play this or look for opportunities with a more longer-term horizon? Obviously, this wouldn't be a call over the next month or two.
I think the one we've been showing in our portfolios has been Latin America.
ILF.
Right? And that's the play on both Brazil and Mexico. Mexico, obviously, for the relative relationship in the U.S. from a geopolitical and backyard proximity, so to speak. Again, a net exporter of oil, but still a net importer of petroleum products. So a little bit of a wash on the energy front, but again, a close neighbor, a close ally, so to speak, for the U.S. So that'll certainly have a benefit. And then Brazil being a net exporter of energy, so they're going to be, a beneficiary of higher oil prices, but not only just oil prices, but commodity prices in general. So you can kind of see if we start talking about that multipolarity, so to speak, you've got basically the Western Hemisphere that we're talking about, and Latin America falls within that. So, that Latin America theme, I think, is really underscores what we've been talking about here with regard to those sort of ideas and themes playing out in terms of portfolios, and it's Latin America products continues to benefit.
ILF is one where in the models I think we have a view that we want that to be a structural holding that we then trade around. So we held it earlier in the year, we took profits, and now we're back in it as of a couple of weeks ago. So I think that is a good place for investors to look for opportunity. Now, one place where maybe there's opportunity, but there's also been a lot of risk lately is software stocks. And I've noticed that there's not been much of a bounce at all in them since the recovery elsewhere in markets. So what do you make of that? Is it a new overhang, or is it just the same old fears around AI?
Yeah, and we've talked about this, I think, in a couple episodes previous to this. But and we sort of said, I think you need to have evidence that AI is not completely destroying the software universe, and more importantly, what are they doing to the revenue streams and the profitability? And I think that's going to basically take a couple of quarters of actual earnings announcements, earnings seasons, so to speak, for that to be sort of proven out. And so you're really getting into the first quarter, I think, where you have a potential overhang from AI, those concerns, and what are we going to finally hear from these software companies? And we'll get a little bit of an idea of how big of an impact this could be. And I think you're probably going to need a couple of other quarters, I think, before investors get really comfortable with whatever that trajectory that they assume to be going forward. Is it being supported by what these companies are saying? So proof is in the pudding. We don't have the pudding yet, so to speak.
But that's one area of the markets where the CEOs are incentivized to say something during the earnings. So I think there we do really want to pay attention and hear what they have to say. I think there'll be an effort to kind of defend the business models, as opposed to maybe some of the other industries, like we were saying earlier. Let's use this war in Iran as a chance to not commit to anything.
And I think the risk, too, in here is that we've certainly seen earnings upgrades stalling out for software. The question, though, is do we have to see them maybe start to be downgraded? We haven't seen that yet. So if we sort of think about it in stages, we're maybe sort of halfway through potentially. And so if it does get worse, we could still see downgrades in terms of those earnings estimates going forward, and that would be the bigger tell, I think. Too.
So are you saying, by and large, up to this point, the earnings have remained intact for software companies? The market has just violently derated them based on fears about future earnings.
Exactly.
And so the next leg down might have to be catalyzed by actual deterioration.
And again, does that just mean sort of the E grows into the PE, and maybe you don't have to continue to see it going down? But the flip side is, if you want to see a catalyst going up, I think you need to see that E starting to sort of manifest into something a little better than maybe what the market's perceiving it to be.
All right. Well, we'll pay attention to software earnings for sure. Anything else as we look ahead to the first quarter earnings season? We've talked about it a fair bit already, but I guess in closing, anything else you're looking for?
Yeah, I would say the last one is historically speaking, you've always seen estimates sort of ratchet down as we run up into the start of the reporting season. And in some cases, you're looking back over the previous 6 months, if you will, in the run-up to earnings season, you get somewhere between, let's call it an 8 to 10% drawdown in those expectations, right? So think about it as the bars being lowered. And then when actual earnings come out, they tend to do better than sort of that revised lower estimate. And sort of then all of a sudden you get this big gap higher in terms of that. And we call that the fishhook effect, right? It takes the shape of the letter J. This time around, we didn't see that sort of revision lower in the estimates. And so is the bar a little bit higher coming into this earnings season? So the typical revision lower of about 10% we get in the run-up to actual earnings season, we didn't get that.
So you're saying earnings estimates just continued to move higher through the quarter?
They've actually, instead of being revised lower, they've actually held steady.
Okay,
so
they've not
traditionally they get revised lower.
Higher, but they've just held
exactly
steady. Okay.
Yeah. And so the argument there is, have analysts finally caught on to this? It's been going on for years and years and years. But the issue here is simply is the bar higher, and that just means would a traditional beat no longer really be a beat because the expectations are sort of much higher than where they have been historically.
Okay. On the other hand, I guess the impression could be, well, the estimates weren't revised lower, so if you beat them, that's even better, right?
Exactly.
Well, regardless, remains to be seeing how that plays out, and it'll be interesting to
Yep.
like assess the market's reaction relative to the
As we
evolution
always
of
say,
those
the
estimates.
the reaction to the news is more important than the news itself.
Yeah.
That's what we'll be paying attention
For
to.
sure. All right. I think that's a good place to end it as we anticipate this upcoming earnings season. We'll check back in next month and see how the early reports have fared relative to those
Yep,
estimates.
exactly.
Thanks
Good.
a lot, Jack.
All
See you
right.
then.
Same, Brian.
Yep.